Why are financial modeling assumptions critical for founder funding? Imagine trying to navigate a new city without a map or GPS. You might get lost or take longer to reach your destination. That's exactly what it's like for founders without solid financial assumptions guiding their plans. When you're looking for funding or trying to grow your business, assumptions are the backbone of your financial model. They turn your ideas into numbers that show how your business might perform in the future. A financial model is like a forecast that predicts revenue, costs, cash flow, and profit over time. But these predictions don't happen by chance. They depend on assumptions about how many customers you'll get, what you'll charge, how much it costs to acquire each customer, and how fast your business will grow. For example, if you think you can get 100 new customers each month, that assumption needs to be based on real data or research. If it's just a guess, your entire model could be off. When you present your financial model to investors, they want to see assumptions that make sense. They want to know you understand your market and your costs. If your assumptions are overly optimistic or vague, investors might doubt your grasp of the business. For example, claiming you'll reach $1 million in sales in 6 months without evidence can seem unrealistic. Clear, data-backed assumptions show you've done your homework and understand what it takes to grow. Assumptions also help you test different scenarios. Suppose customer growth is slower than expected. By changing your assumptions, you can see how that impacts your cash flow or profitability. This helps you prepare for risks and shows investors you're thinking ahead. If costs unexpectedly rise, you can adjust your assumptions and see how it affects your bottom line. This kind of planning makes your business more resilient and trustworthy. From an operational point of view, assumptions help you track progress. If sales are below your projections, you can check your assumptions about customer acquisition or pricing. This allows you to make quick decisions to fix issues. For example, if your customer conversion rate is lower than expected, you might need to improve your marketing or sales process. Using assumptions as a guide keeps your business on track and prevents surprises. Networking with potential partners or investors often involves sharing your financial model. The strength of your assumptions can influence how others see you. If your assumptions are realistic and well supported, they'll see you as a serious, credible partner. On the other hand, shaky assumptions can lead to misunderstandings or missed opportunities. Clear assumptions build trust and make your conversations more productive. If you're also investing in other startups, understanding assumptions is just as important. When reviewing their models, look for assumptions that are specific, realistic, and supported by data. For example, check if their customer growth projections are based on actual market research or just optimistic guesses. This skill helps you spot promising opportunities and avoid risky investments. Building a good financial model starts with gathering real-world data. Talk to potential customers, analyze competitors, and test your pricing. Document where each assumption comes from so you can explain it clearly. Keep updating your model as you learn more about your business and the market. This ongoing process ensures your assumptions stay relevant and accurate. In the end, assumptions shape how investors, partners, and even you see your business's potential and risks. They are the foundation for trust, scenario planning, and clear communication. Getting them right can open doors to funding, strategic partnerships, and growth. If you get them wrong, those doors can close just as quickly. That's why paying close attention to your assumptions is one of the most important steps in building a successful startup.